Global growth momentum peaked in the second quarter, as we've been expecting, but it looks like the slowdown is very modest. Of course, a surge of trade drove the pickup over the past year. That's also leading the slowdown. And of course, that's mostly felt in the open economies across Asia. Other evidence we have of a slowdown is the economic surprise index. That's whether the data is better or worse than expected. That's back to neutral levels, having been really strong earlier in the year. And PMIs, they're beginning to soften as well, even though they're still comfortably over 50. America is soaking up its excess workers, but there's still no inflation. That's causing a dilemma for the Fed, and as a result, we're scaling back our expectations for interest rate increases. Still, America's been untroubled by the political chaos, either the economy or the markets. That might not last, because unless they can pass laws in September, there's the risk of a government shutdown or possibly even a default. Europe and Japan are both fine, but inflation means Europe is much closer to ending QE than Japan is, and we should indeed have an announcement on that before the end of the year. But both are at much of a less mature stage of the cycle than America. So overall, the expected slowdown is coming through, but it's very moderate so far. The next recession still looks much too far away even to begin to guess on the timing.
Major markets were becalmed through the whole month of August. US stocks were down all of 1 percentage point. Europe was mixed, and Asia too, apart from the gains registered in China. The conclusion of the second quarter's earnings report held more for the optimists than for the pessimists. Earnings numbers were strong, if not exceptional. This clearly helped to support markets, despite growing misgivings about high expectations for future earnings in shares. As we share some of the concerns about the elevated level of equity markets, we refrain from adding new risk to our house view portfolios. Economic fundamentals are still sound. Our previous call for moderation looks about right, and the trendless reaction of the equity market is also more or less in line with this scenario. In fact, we urge clients to keep to the idea that now is a good time to look at expensive equities that have done well and rotate into laggards that may offer better value or be more defensive in nature. We also remind investors of the benefits of diversification. Highly concentrated portfolios can be excellent, terrific performers when the going is good, but are exposed when corrections happen. While there has been an increase in perceived geopolitical risk this month, the effects of such events look as fleeting as ever. Pronouncements made by politicians can have temporary effects on market sentiment, but are usually not causes of significant changes in fundamental market drivers. We do not think this time will be much different. In fixed income, we have likewise not moved our allocation in the last month, but we reiterate our previous call, namely that it is important for investors to begin moving credit exposures in high-yield bonds towards the higher rated end, that is BB, from the lower credits. As a reminder, this view is based on the observation that by several metrics, the risk-reward of lower-rated areas of the credit universe has become expensive compared to less risky bonds.